Good morning, dear friends. For the last two sessions, we have been discussing the various issues or matters which pertain to the provision of Income Tax Act in respect of the computation of income under the head capital gain. We learned that in our earlier discussions, we learned that the capital gain or the gain or profit which arises from the transfer of capital asset effected during the previous year is computed under the head capital gain. So we discussed in detail what do we mean by transfer, then the capital asset, then if there is a transfer of capital asset, only then the question of capital gain will arise. So that we have already discussed in our last lectures. I am just going to recapitulate. So any transfer of asset means capital asset which has been effected during the previous year and which results in the any gain or profit, then it would be taxable under the head capital gain under section 45 unless some exemption is given under the various provisions of the act. We also learned that the incidence of tax, the incidence of capital gain tax depends upon the type of capital asset, the type of capital gain, means the incidence of income tax under this head shall depend upon whether it is a short-term capital gain or a long-term capital gain. We also learned that how to calculate the short-term capital gain and how to compute the long-term capital gain. We also discussed what do we mean by short-term capital asset. We discussed that any capital asset which is held by an assessee for a period of not more than 36 months immediately prior to the date of transfer is called short-term capital asset, and if it is held by the assessee for more than 36 months immediately prior to the date of transfer, then it is called the long-term capital asset. However, this 36 months has been substituted by 12 months in respect of certain specified assets, particularly in the context of shares. That we have already discussed. We also elaborately learned the computation of short-term capital gain and long-term capital gain with an example. In my last lecture, I just gave you the examples also, and we just computed the short-term and long-term capital gain. So today, I just want to give you I'm just going to start with the comparison, with the distinction between the short-term and capital gain and how that is to be compared. Then we will proceed further. Now, how to compute the capital gain under section 48? We have already done it. We have learned the computation of short-term capital gain and also learned the computation of long-term gain in our earlier discussions with an example. So I'll just give you the bird's eye view of the difference between these two, which is very, very important for further discussion. So we just start from the computation of short-term capital gain. First of all, we'll find out the value of consideration. I'm just discussing the short-term capital gain. It means, first of all, we'll find the full value of the consideration, and from the full value of consideration, the expenditure which assessee has incurred wholly and exclusively in connection with such transfer, it will be allowed as a deduction. Then we will deduct the cost of acquisition, and if there is any cost of improvement on the asset, then it would be deducted, and the resultant figure would be the short-term capital gain, and it will be subject to tax unless the exemption is provided under the Act by section 54B, 54D or 54GA. So this is a simple process of computation of short-term capital gain. If we want to calculate the long-term capital gain, then the process seems to be quite similar, but instead of deducting the cost of acquisition, will determine the indexed cost of acquisition or indexed cost of improvement. So the indexed cost of acquisition and indexed cost of improvement forms the basis for the computation of long-term capital gain. Otherwise the things, they seem to be the same. So what is the major difference between the short-term capital gain and long-term capital gain is, among other things, in the long-term capital gain, the index cost of acquisition and the index cost of improvement, if any, they form the basis for the purpose of computing the capital gain. Now we'll discuss the benefits of indexation which are not available. As you learned in my earlier slide, that the indexation means the cost of an indexation cost of acquisition and the index cost of improvement, these two things form the basis for computation of long-term capital gain. It means whenever we talk of long-term capital gain, immediately we'll have to have the indexed cost of acquisition or the indexed cost of improvement in respect of the long-term capital asset. But there are some of the examples where there may be the long-term capital asset, but certainly the benefit of indexed cost of acquisition or the indexed cost of improvement, or in other words we can say the benefit of indexations are not possible. What are those cases? Because this is very, very important for our further discussion where we want to calculate the capital gain in respect of some special cases. We will just discuss in the subsequent lectures. So this is a list, small list. So the benefits of indexations are not possible, are not available, sorry, in the case of short-term capital assets. Means the first that would be ruled out because indexation is possible only in the case of long-term capital asset. So if any capital asset happens to be short-term capital asset, and obviously the benefit of indexation shall not be applicable, not available. The second is the bonds or the debentures other than the indexed capital index bonds, because these capital index bonds are specifically then issued by the central government. In respect of capital index bonds which are issued by the central government, the benefits of indexation are possible, they are available, but other than that, if the bonds or debentures are issued, then the benefits of indexations are not available. Third is the shares and debentures which are acquired by a non-resident in the foreign currency. If any non-resident acquires the shares and debentures of a company which is an Indian company and such acquisition has been made in foreign currency, then the benefits of indexation will not be available to him. Next is the depreciable assets. In the case of depreciable assets also, the benefits of indexation, they are not available, and that is other than the assets which are used by the power generating units which are otherwise eligible for depreciation. Here we are talking about the depreciable assets, means for example plant and machinery. If the plant and machinery is being held by the SSC over a long period of time and some gain or profit arises out of the transfer of such plant and machinery, even then this plant and machinery happens to be the long-term capital asset, still the benefit of indexation shall not be available because this is specifically excluded. So depreciable assets other than the assets which are used by the power generating units, that I think the special concession has been given to the power generating units which are eligible for depreciation. In this case the depreciable assets is eligible for the indexation benefits. Next is the undertaking or division which is transferred by way of slump sale. Slump sale means where the sale of undertaking has been done for a lump sum amount. There is no, for lump sum amount somebody has sold the division or undertaking. If that is the case, then the benefits of indexation are not available to the SSC. The next case is the JDR, the global depository receipts which are purchased in foreign currency, no indexation benefits are available. And the last is the securities which are purchased from the FIs in terms of section 115 AD. So this is a small list of items in respect of which the benefits of indexation are not available. Now we'll discuss the cost of acquisition and the cost of improvement. I just want to reiterate again that the cost of acquisition and the cost of improvement shall form the basis for the computation of the short-term capital gain or the long-term capital gain. When we talk of the indexed cost of acquisition or the indexed cost of improvement, immediately we are just referring to the calculation or the computation of the long-term capital gain. Now the question arises, what exactly is the cost of acquisition? I mean, what is deemed to be the cost of acquisition or what is deemed to be the cost of improvement, means what is to be included in the cost of acquisition. This is a very, very important thing because it is going to form the basis for your computation of long-term capital gain. So the cost of acquisition means, particularly when I am talking about the cost of acquisition, is cost of acquisition with reference to the capital asset. It means the value for it was acquired. It means when we talk of acquisition, we are just referring to the value. Now, for this, knowing the cost of acquisition, you will have to refer to the various judicial decisions. And as per the various judicial decision, this particular concept can be explained with the help of the following example, which is to be included in the cost of acquisition. For example, interest which has been paid by the assessee on the borrowed capital to purchase the asset, then this interest shall form the part of acquisition. It means it will be added to his cost. Second is the litigation expenses which are incurred for compelling the company to register the shares in the name of the assessee. Then this litigation expenses shall also be the part of cost of acquisition. Another example is that amount paid by the successor to clear the mortgage. It may be cases when a person is entitled to the inherited property, but this property was subject to the mortgage at the time of death, and this particular mortgage also subsists at the time of the previous owner. But to clear the debt, the successor had to clear the mortgage. It means he had to pay the amount. Then the payment of such mortgage such amount shall be deemed to the cost, and it will form the cost of acquisition. Similarly, if a person has inherited property and he is required to pay the estate duty in respect of the inherited property, then it shall not be deemed to be the cost of acquisition, means that will not be added to the cost, particularly estate duty. And the ground rent, for example, if a person has to pay some ground rent in respect of the property, then this payment of ground rent shall not be deemed to be the cost of acquisition. Because this cost of acquisition, I just want to reiterate again, the cost of acquisition or the cost of improvement provides the basis. It means that base should be very clear what is to be included in the cost of acquisition and what is not to be included in the cost of acquisition. It makes a lot of difference. So I think this is very, very important. Means again, I just want to stress interest on borrowed capital to purchase the asset, that is deemed to be the cost of acquisition. Similarly, litigation expenses are the amount paid by the successor to clear the mortgage. These are deemed to be the cost of acquisition. Now, this cost of asset to the previous owner, section 49, means subsection 1 or section 49. This is a very, very important provision. What shall be the cost to the assessee if he has acquired the property from the previous owner? Before I just discuss in detail the cost of asset to the previous owner, I just want to discuss this particular thing with an example. Then, after having understood something out of this example, we'll just try to deal with this particular matter in detail. Now, as per the case study, if you kindly see the case study, as per the case study, X, Hindu undivided family having two members, X and Y. So there is a one Hindu undivided family HUF and it has two members, X and Y. The family is undergoing a partition. The balance sheet of the family immediately before the partition on March 31st, 2007 is as follows. So this is the balance sheet of HUF. So it means they are just undergoing a partition. And there are two members in this HUF. The balance sheet is that this HUF has got two houses. House 1. The market value of house 1 as on 31st March 2004. Acquisition was, date of acquisition was 31st March 2004 and the market value as on 31st March 2007 is 60,000. That is in respect of house 1. And it has got another house, house 2, whose cost was 40,000. Means the cost of acquisition was 40,000 and this particular house was purchased on July 10, 2004. Present value of this house 2 is 1,50,000. Now these two houses are there and the two HUF members are there and they want to finalize the partition means it is undergoing a partition. If you kindly see that there are two options. The first option which is available to the HUF is in the Hindu undivided family is that they should sell both the houses, that is house 1 and house 2. The net consideration after having paid the capital gain if any in respect of both the houses, they could have disbursed the amount to the both the members of the HUF. It means to X and Y. Means the first priority would be they would be selling the houses, means sell the house 1 and 2 and sell the houses, pay the capital gain if any and distribute the amount between these two members. Another option is that they should distribute both the houses to the two members, means for example the house 1 may be given to Mr. X and the house 2 may be given to Mr. Y at the market value. I think the second option is, it calls for that, first of all, we should try to understand that if the HUF resorts to the second method, it means it is going to distribute, it is going to give house 1 to member X and it is going to give house 2 to its member Y, then it shall not be deemed to be the transfer because it does not involve the element of transfer. As I discussed earlier also, if there is a partition in HUF and there is a distribution of property under the HUF under partition, then this partition shall not be deemed to be transferred under section 47. Because remember it, that the question of profit or gain arises when there is a transfer of capital asset. It means the word transfer, if the element of transfer is not there, it means the transfer, if the element of transfer is missing, then the question of capital gain shall not arise. So if there is a distribution of assets under the HUF, there shall not arise any capital gain. So in respect of this, if house 1 is given to Mr. X, it will not result into any capital gain. It means what will happen? Mr. X will get the house 1 at a market price of 60,000. It means he is getting house at a market price of 60,000 and this house was purchased for 10,000 rupees. It means the balance, the capital gain of 50,000 shall not be payable by Mr. X if he gets the house under the partition. It means the 50,000 capital gain, which is the capital gain to the family, shall not be paid by Mr. X at the time of the partition if he gets it. Similarly, Mr. Y, who is getting second house, the market value of the house is 1,50,000 and the cost was 40,000 at the time of acquisition when that house was purchased, when the house was acquired by the HUF. It means he will also not be liable to pay a capital gain of say 1,10,000 at the time of getting this house on account of the partition. But if this particular Mr. X, if he sells the house, so long as he is owning the house, he is holding the house, the question of capital gain shall not arise. Means he will not be required to pay any capital gain out of it. Now you suppose that Mr. X, he sells the house after 6 months. He sells the house after 6 months, say for 87,000. Now in this case, he will not only pay the capital gain on his own account, but he shall also be paying the capital gain of 50,000 which he had, which capital gain pertained to the HUF. It means at the time of the sale, if he is getting 87,000 after 6 months, then the cost of asset to the previous owner means 10,000 which was paid by the HUF, then it will be due to the cost to him also. So 77,000 capital gain he will have to pay. It means so long as a member of the HUF he receives any property out of the partition, then at that time he is not required to pay any capital gain. But later on, subsequently, if he sells the property, if any capital gain arises, then he will have to pay not only the capital gain on his account, but on account of the capital gain which could have been paid by the HUF also. So means that 77,000 would be payable by him as a capital means that would be capital gain in his hands. Here, if you just see the transition, the sale consideration is 87,000, and the cost of asset was 10,000, and this cost of asset was 10,000 to the HUF. Now, in this case, the cost of asset to the previous owner shall be deemed to be the cost of asset in his hands. So, based on that, 77,000 amount he will have to pay. Had he not sold the house, then nothing was payable from him. So, with this point, I just end this lecture, and we'll just try to understand the cost of an asset to the SSC, where a particular SSC gets the asset from some other owner, that we'll just try to understand in the subsequent discussion. Thank you very much.